In the alternate version of Quick Study 4-3, we're going to calculate some different income statement amounts for a service company compared to a merchandising company. So let's start out with Craig's Service Company, and by now you're a master at calculating income amounts, like net income for a service company. All we do is simply take our revenues of $20,000 minus our expenses of $9,100, and we come up with a net income of $10,900. Now, there are some extra accounts listed, and sometimes that can be confusing. You think you need it to calculate this problem, but you don't. Dividends. What statement would it appear on? Wouldn't be the income statement. It would be what? Statement of retained earnings. What about some of these different assets, liabilities, and equity accounts that we have listed farther down the list? Are they part of the income calculation? No, they're going to appear on the balance sheet. So as far as the first part of this, for calculating net income for Krug, we're finished. So we move on to our merchandising company and probably thinking, this problem seems very easy. I'm just repeating what I've learned in past chapters. And we start to see some differences. For example, while service company calls it revenues, the term shifts a little bit for a merchandising company who's actually buying and reselling a tangible good to its customers, and we call it sales. We also see just expenses listed here, but this is operating expenses. Keep in mind, some of the expenses are similar between a merchandiser and a service company. Things like advertising expense to promote its product to its customers, utilities expense, payroll expense, maybe rent expense on its facility. But there's one other very important category of expense that a merchandising company has that a service company doesn't have. What is that? That's cost of goods sold. Its cost of the product that it sells to its customers. That's not something a service company has. Unfortunately, I don't see that listed here directly. If Kleiner had been a perpetual inventory, used a perpetual inventory system, we would have seen it listed directly. What type of system does Kleiner use? It uses a periodic inventory system. So we're going to have to calculate cost of goods sold. Don't get scared. Let's start to list what we do know. We do know that beginning inventory is $8,000, so we'll list that. We also know that our total purchases are $8,700. So let's think about this. What I started with, $8,000, that's what I had on hand at the beginning of the period, plus what I bought of $8,700. That's what I have available for sale, or what we call cost of goods available for sale is a combination of $16,700. That's what I have available to sell to my customers. I can do one of two things with that. Either I can carry it forward to the next period, so it's available at the beginning of the next period, or what else can I do with it? I can sell it to my customer. It becomes cost of goods sold. So I do have the amount. Periodic inventory system, we went out, as far as Kleiner went out and counted and valued its inventory. We do know that that's $3,600. That's the amount carried forward to the next year. Well, if I know beginning inventory is $8,000, purchases are $8,700, and I have $16,700 available for sale, and either that's going to be carried forward or it's going to become part of cost of goods sold, they can just take the available $16,700, subtract from it $3,600 for ending inventory, and I come up with cost of goods sold must be $13,100. Keep in mind, these two have to add up to available for sale. So if I subtract ending inventory, which I went out and counted, I get cost of goods sold. I can also list this formula a little bit more detailed. Beginning inventory 8,000, purchases 8,700, minus ending inventory 3,600 equals my cost of goods sold of 13,100. And I can list this a little bit more formally in my income statement. I have my sales of 15,500, and I step through the same calculation I did down here. Beginning inventory of 8,000. Purchases of 8,700 gives me cost of goods available for sale, not sold, but available for sale of 16,700 minus my ending inventory of 3,600 equals my cost of goods sold of 13,100. Now, I'm already calculating some of the amounts I need later in this particular problem, but don't get too excited. We're not done yet. We have some additional amounts we need to calculate. For example, A merchandiser is going to have another calculation called either gross profit or gross margin. We take our sales dollars of 15,500 and subtract one of our expenses, cost of goods sold of 13,100, and we get something called gross profit or gross margin, in this instance of 2,400. Merchandiser wants to do a comparison between its selling dollars and what the product costs for it to get gross margin or gross profit. But we have some other expenses. Our operating expenses of 1,750. So things like our advertising, our employee expenses, our utility expenses, our rent. Subtract that from our gross profit of 2,400, and finally we get our last number of $650, our net income. Make note of some of the different items that we have to plug in for this problem in terms of cost of goods available for sale, cost of goods sold, gross profit, and net income.